Wanted to go ahead and start rolling into our next couple of speakers here. Our own Farm Credit VPs, Blain Hellman and Jason Rust. So Blain is the VP Crop Insurance based in Sherman office. He has been with Farm Credit for 6 years. And then also joining him is Jason Rust. Jason is a VP of Crop Insurance based out of Watseka, Illinois. He has been with Farm Credit for 21 years. So, you know, I've been here for in my short time of being here. I witnessed a passion between these guys and all of our other crop insurance agents, just really having the match and the right protection that aligns with each grower's operation and their goals. So it's been really a pleasure to watch them work, and we're going to hopefully demonstrate that today. So we're going to go through some updates from a crop insurance, including some of the updates that we've just received at the end of the season, and also start doing some inquisitive. These two also have the opportunity to work crop insurance. Also, they have a farm that they also work on too. So kind of a good perspective as we speak today. So with that, I'm going to go ahead and turn it over to you guys to kind of kick things off. But as you see there, I just want to help kick things off here is, when you see what does your farm, your coverage protect what you've built, in your guys' words, what does that mean to you?
Well, I'm just going to take a minute and say, that was some really good information that we received from Jason Webster. And I've got a couple of phone calls to make on my way home. One to my seed guy that I've got my 1742 bought and paid for. I'm going to see if I can get it picked up and in my shed. And then the second one is to my teenage kids to see what their schedule's like in April and May, and if they know how to lay drip tape. Your farm, your coverage. I was the one on the introduction video, and I said it in there. No two farms are the same. No two farmers are the same. So it truly is your farm, your coverage. Just because your neighbor is doing something, with crop insurance doesn't mean that that's necessarily, built for your farm. Like I said, I'm involved in the farm. A lot of our agents are in here today. We'll introduce some of them later on. A lot of them are active in a farm operation also. So, we all buy the product that we sell, and it's very important to us for you guys to protect what you've built over the last couple of years with some really good crop years in there. And then one of the slides that Jason had was, the last one or two, and one or two ahead of us here projecting to be lower margins. So, protecting that lower possibility of lower margins. So that's what your farm, your coverage, and protect what you've built means to me.
Yeah, Jason spoke really well to that. I think I only would add that, one of the benefits we have as, having the access or ability, we work on our own farming operations as well, is, having the ability to see these products, see how they work, and in our case, we wouldn't sell you something that we personally wouldn't buy ourselves. So we study these products, and like Jason said, every farm's different, and there's so many options out there. Amongst the 4 AIPs we work with, we have a great ability to put together a package that is going to curtail what you want to get out of your farming operation and your coverage levels. So, so that's what it means to me as well, just to echo off of what Jason had already started saying.
So the three main things that we're going to talk about here coming up, shallow loss coverage, ECOs, SCOs, policy elections, and just looking ahead to what's coming with the Farm Bill decisions, and looking ahead to the future a little bit, even about what some changes that might be made a year or so from now. There's not a lot new in crop insurance this year, but that doesn't mean that it's still not a really important decision coming up here in the next 5 or 6 weeks.
So again, there's not a whole lot of changes going into 2025 as far as when it comes to crop insurance. The biggest thing, as you can see on the top, when we talk about shallow loss coverage levels, the enhanced coverage option, I'm sure you've all heard about it. It's been around since 2021, and we've been harping on it here for the last few years. For 25, the subsidy has been raised from 44% to 65%. definitely making it more economically feasible. Along with the enhanced coverage option, you have the supplemental coverage option. That subsidy remains at 65%. So that is a coverage level up to 86%. And I should have mentioned the ECO is from 86 to 95. Again, both of those options are county-based coverage that trigger off the county's revenue. And then we have private banded products that each AIP we work with, whether it be Great American, Rain and Hail, RCIS, or Agrisampo, have their own versions that we can get individual coverage up to those higher levels. But again, not subsidized products. But as we talk about the last couple of years, and before us, Jason Webster mentioned we had some dry Junes, but yet we've been through some adverse weathers, but still had some pretty darn good yields the last 2 years. So kind of where we live going forward, it seems like these shallow loss areas, that 85 and above. I know in 23 with the drop in price, 85%, even 80 paid because of the drop in price. And they did their job, but as we move forward, and costs still remain high, if you want that more revenue coverage on your farm, these are some options we need to look at to get to that higher level of coverage.
So this slide here, one of our agents out of our Mahomet branch put this together. We call this our silos. So I guess for you guys, it'd be on the left-hand side. The black bar is just representing if you took a revenue protection policy at the 80% level. The green is if you bought SCO. SCO's max amount of coverage is 86. So in this scenario, your underlying policy is your 80%, your SCO is from 80 to 86, and then the blue is ECO from 86 to 95. And then, in this scenario, you basically have a 5% deductible. If you do choose to buy SCO, you have to be enrolled in PLC at the FSA office for your farm bill decision. We'll discuss that a little bit more here coming up in some slides. The middle silo is if you choose to just go with an 80% policy and SCO. The SCO and the ECO are both county-based coverages. The amount of coverage is actually based off of your farm, but the trigger point is county yield and price. And then the right silo on your screen there is something that's been kind of popular in the past is, buying the 80%, leaving the gap there and not buying the SCO, and then buying the ECO from the 86 to 95% coverage range. And that's just, that's been kind of something that we've suggested to manage premium in the past. Now this year with the higher subsidy level on ECO, that may be an option there that you want to look at. And maybe you go back to 85% on your underlying policy and still buy the ECO at the 95% level, due to the reduced premium of the ECO. You got some examples just like what the premium was for like Sangamon County here last year versus this year?
Yeah, and so again, back, like I said, ECO's been around since 2021, and it seems like in the last couple of years, the expected county yields have really been elevated. So for example, in Sangamon County, the expected county yield for this product is 226.9. So like last year, to go from 86 to 95% was about $31 an acre in Sangamon County. This year is going to be more like 18 to 19. So you're seeing a drastic drop with that additional subsidy, making it maybe either, like Jason said, more advantageous to bump your underlying coverage back to 85%, or even still leave it at the gap and maybe keep your underlying coverage 80%, add the ECO, and maybe take some of that extra savings and apply it to hail, wind, other coverage levels that you may need to bump up.
Hey guys, as you guys have been speaking with a lot of your members and insurers, what kind of interest have you seen with ECO and SCO as you guys are having those discussions here over the last few weeks?
So Blain said ECO was first available in 21. It's shallow loss coverage, only a 5% deductible. A lot of your universities came out and said, that if this was available over the last 20 years, it would pay something like 3 out of every 5 years or something like that. On my farm personally, so I bought it 21, 22, 23, did not pay. And this is where you have to talk with your agent, look at the expected yield for the county. So I farm up in Iroquois County, and we have one of the lower expected yields compared to what we have been producing over the last 5 years. So it just, it did not work in those years. I have some surrounding counties that I sell in, Vermilion County, Champaign County. It's worked great in those counties. It's paid in those counties probably the 3 out of 5 years. So yes, I have sold some in the past. I've bought some in the past. With the subsidy change, we'll definitely, look at it again this year and probably have that conversation, a lot more just because of that subsidy change.
Yeah, and as I mentioned, just before, about Sangamon County's yields, I live and we work in a different area than Jason, Logan, Sangamon, Menard, some Christian County. We have a little different scenario. We have the higher yields. So like Logan County's 227.8, as I mentioned, Sangamon at 226.9. So you're getting 95% coverage of that as well as with the price. So, it's been very advantageous. Saw some purchases in 23. That product paid very well especially with the drop in price, and we had lower county yields in 23. This year we don't know the county yields yet. We will in June. But still not as great a drop in price, but I anticipate that it'll pay to some extent again this year. It just depends how great or less depending on what our local county yields come in at. But again, this is becoming more of a topic conversation. Again, like I said, as our individual yields and our APHs have gone up, and with these products, what you can get with 80, 85, obviously still good coverage, but this kind of gives you the best of both worlds of if you have an isolated incident on your own part of the county, or vice versa, you can get paid on one or the other in a given year, depending on what your situation is. So it kind of gives you a double-edged level of protection, and some guys like that. So if take the bet on themselves and see if the county has a problem is kind of how some guys look at it and are okay with dropping their individual coverage to 80. Even some guys have done 75% to save money. So it just depends on your level of risk and what you're comfortable with. But these are all conversations I think that we all have on an individual basis to make sure we're doing what's right for your operation and your setting.
So along with what Congress passed December 21st of 2024 was an extension to the Farm Bill. So it's still the 2018 Farm Bill. They have extended it one more year, and that is your ARC PLC decision is involved in that Farm Bill. And sign-up period is started Tuesday, so the 21st, I believe, and it was initially supposed to be March 15th deadline, same as crop insurance deadline. Since they kind of got a late start to it, they did extend that ARC PLC decision to April 15th, 1 month later than the crop insurance decision.
With the April 15th, were there any other changes in 2025?
So both ARC and PLC, both have higher coverage levels than what they've had in the past. So it's a little bit different than our crop insurance policies. Just the way they're designed, using 5-year Olympic average yields, county-based, and 5-year Olympic average prices. So we're still taking advantage of high prices in 21, 22, 23 when we're figuring those numbers. So Arc County, for example, the corn guarantee is 503 this year for the 25 crop year versus 485 for the 24 crop year. Soybeans 12.17 versus I believe it was 11.12, something like that. $11.12 a bushel in 24. The wheat price there of 6.72. So the triggers, for those products have really increased from what they were in 24. Cover PLC a little bit.
Yeah. So again, as price loss coverage is exactly as it sounds. It's strictly based on price. And again, that's one of the changes this year is, so last year the PLC reference price was 401. Due to that Olympic average and rolling average, we dropped off some of the back lower years, and we've had an increase up to 426 on corn, 966 on beans, and 556 on wheat. So, as we talk, I guess, we go forward and we'll talk about maybe some options, but also maybe brings it more into play a little bit, depending on what your opinion of the markets are as far as the PLC option. Again, that has to be from the marketing year, so the end of the September 1 of this year is what you're electing for through the end of August of next year of 26. So the whole marketing year, that the average corn price has to be below 426 for that to pay. But again, it all depends on what's your opinion of the market, where we're heading here for the next year. So, but definitely has made a little bit of a change and more of a conversation with these higher prices to these different programs.
Yeah, so as of right now, we are still in the 24 marketing year. So the 24 marketing year started September 1st of 24 and runs through August 31st of 25. And so that's for the decision that you made last year at the FSA office. The decision that you're making coming up here in the next 2 months is for the 25 crop year. And that marketing year is not going to start until September 1st and go till August 31st of 26.
I know there's always different strategies and plans to align with goals and that, but what are you guys are thinking about, ARC and PLC and within your own operations?
So again, I hope there's no USDA FSA employees in the room. I'm not saying wait till the last minute, but I'm kind of waiting to see here, maybe as we get more into March, kind of what our weather dictates, what we're talking about for planted acres. And I think it's going to depend on maybe what you or even I individually elect as a coverage option. But I think the elevation in the PLC price, like I said before, kind of brings that maybe more into the conversation rather than just electing PLC if you want the SCO coverage. So if there's talk we're going to plant 95 million acres of corn, we don't have any weather issues, that could bring into play a 426 type below that for the marketing year. I mean, we obviously hope not, but I mean, that is a real situation. And, or if you've listened to, in our previous meetings of these fielding forwards, we had Eric Snodgrass in his climate model he thinks there's like a 60% chance we have a drought. So, I mean, I think we're still in there early on here to make that call. I guess what I'm thinking is since Ark County kind of acts as the area revenue coverage, kind of like what is very similar to what ECO is, except it's more like a harvest price exclusion on the Ark County. If I elect ECO and say into 80% on my individual coverage, I may be apt to elect PLC because I already have the area coverage on my top level, and that way I kind of diversify my risk strategy. So that's maybe something to look at. But like I said, I think kind of let this thing play out, see what the market wants to do, and kind of where we maybe want to hone in on what our weather looks like and kind of intentions look like.
Yeah, when I first discovered that PLC price was moving from 401 for the 24 crop year to 426 for the 25 crop year, personally, I thought it was going to be a no-brainer to take out PLC. And then I started running. We have a program. All the agents in here have a program that we can, enter in scenarios, and it, spits out all the numbers. I haven't got drastic with my scenarios that I've ran, but a lot of the scenarios that I have ran, ARC actually looks like the better option. So, I'm leaning a little bit more towards ARC. On soybeans, I guess I'm leaning, towards ARC definitely. Corn is kind of a toss-up. I like that 426 as a put option. Has nothing to do with yield. The last 4 or 5 years we've had high yields and low prices, so PLC makes sense. You can hedge your bet, so to say, and you can enter some farm numbers in Ark County and some farm numbers in PLC. One thing to remember here with the ARC, he had mentioned, similar to a crop insurance policy, similar to ECO, but it does not protect you in a dry year if our October price comes in a lot higher, on crop insurance than what our February price does. Your ARC County guarantee is not going to rise like your underlying coverage is if you buy RP and if you buy ECO. Those numbers are going to rise in a short crop, high price year. ARC is not going to do that.
Yeah, agreed. And like I said, I think sitting down with your agent, we can run these scenarios. But like I said, I think, both have it, like I said, with the higher prices, you can make cases for both. But I think that more play on corn. Soybeans, I'm leaning definitely ARC County on the soybeans. But, again, work with your agents. We can walk you through this and kind of see and also based on what your opinions are of what you see going forward.
And part of that too, going ARC on the beans, in the history of the Farm Bill, PLC has never paid $1 on soybeans. Not saying that it won't someday. The ARC and the PLC on corn has kind of been a toss-up. There's been a few years where PLC has paid. There's been a few years where ARC County paid. So that's what I'm basing most of my decision on the soybeans, ARC County. And another thing, you look at the $12.17 for the ARC County, and you take 86% of that, which is your county guarantee. I believe you come up with $10.50 some cents versus the $9.66 price for the PLC. So that's another reason why we're kind of highly recommending soybeans on the ARC side, and the corn just, up to you, and, split it up if you want to. The next couple of slides, we're going to talk just a little bit about unit structure, a little bit about hail, wind, replant, some extra policies that vary by AIP, vary by company.
So really the big change, I know it doesn't affect a lot in this room. We do have some organic growers in the area. New for 2025 is the enterprise units by organic practice. So it's allowing you to separate your databases by practice on the organic side versus your conventional.
So, been this way for a long time. The OU, BU, EU, that is your underlying policy that you take. And that is, we call it unit structure. So how you want to insure your farm. Enterprise unit is every acre in a county is one guarantee, cheapest way to insure. Basic unit is by shares, so you can break that out. 100% farms, 50% farms would each have separate guarantees. And then there's optional unit, which is by section. And that's the most expensive way to insure, but those are your three options for unit structure on your underlying policy.
And the ones below, EC is enterprise by cropping practice. This really doesn't probably affect many in this room. This is for like double crop soybeans down south. They can segregate or keep those separate. EI, enterprise by irrigation practice. You can enterprise your irrigated acres and your non-irrigated. EO, as I just mentioned, enterprise units by organic practice. And then MC is multi-county enterprise unit. So if you have a farm across the county line, if it's maybe one or two farms, you don't have it very far from your others, you can bring in, like, for example, a county that touches your existing county. So if you farmed in Menard County, you can bring in Logan, Sangamon could bring, touches up against Christian County, and so on and so forth.
Well, there's a lot of options there and a lot of things to choose and think through. So when you guys look at those structured options and unit structures that we have, what are a couple examples you guys might have for going away with that would be more advantageous?
So one thing that I do, probably more so on soybeans than on corn, just because the difference between your enterprise and your optional premium is on soybeans, sometimes it's only $4 or $5 an acre different to go that optional unit route versus enterprise. Corn, you're probably looking at more in that $15 an acre range to go enterprise and optional. So I understand that gets a little salty for the budget. But one thing that I've done with a lot of customers over the past few years is convince them to go the optional unit route on soybeans. And one strategy or play, if you're buying a hail policy, you can maybe back off that hail coverage a little bit, depending on what level you're at, and save a couple bucks an acre there on the hail policy, put it towards the optional unit on your underlying policy. And, if you do have a hailstorm, you have separate coverage. If you have 180 that gets hit with hail and it's bad, if you're under your guarantee, you've got the optional unit coverage there. So I farm and sell a lot of insurance up in Iroquois County this year, and we were super dry towards the end of August, beginning of September. On my farm, I had almost a 20 bushel swing from my best beans to my worst beans, and my worst beans were my 3.7s. Had a claim on that one field of beans, and had a lot of customers that was the same way. When we got to looking at the price loss and the lower yield on some of those later beans, we triggered a lot of claims this year, and most all of them were based off of having the optional unit versus the enterprise unit. And that's just another thing that's farm by farm and farmer preference, but that is one thing that I've done in the past quite a bit here.
Yeah, I'd be similar in my examples. I don't have probably near as much as Jason does, but as we do get in areas where you see a variance in your databases, soybeans, the jump is not near as expensive. So really haven't done a lot of this. I mean, I have some guys that choose to do optional units on corn, but again, it's a price jump to separate that out. And a lot of our guys, we're farming similar ground. Enterprise is still good coverage and still probably to your advantage cost-wise as well.
So the hail, wind, and replant, extra endorsements, important to realize that the hail coverage provides more than just hail. Provides stored grain coverage, vandalism, fire. Fire is a big one. Your multi-peril policy does not cover field fires. Your farm liability policy that you buy, if you burn your own field up with a combine fire or whatever, your farm liability policy is not going to cover that either. Your crop hail policy will. Your farm liability policy, if you burn the neighbor's field up, it'll help you out there. But as far as burning your own crop up, you really need, a hail policy to take care of that.
And then the other components of the, is the wind. And, every area is a little different. Kind of the counties that I cover and work here locally, we seem like we have more and more wind issues from year to year. So there's really three components to your wind policy. There's the green snap wind, which is irrecoverable ears that they'll come out and check after you get done harvesting, do stand counts. And then that bubble's not up there, is extra harvest expense that comes from down corn, and you having to either, like I said, slowing you down due to tangled up down corn, having to pick corn one way, et cetera. So those are the three components. They can all be bought separately, or you can, a lot of times, in most cases we do is bundle them together so you protect yourself from throughout the growing season. Especially like the last couple of years, we had a derecho not long ago that came through Sangamon County. Was a big benefit having the wind policies in effect. Even this last year, dealt with a fair amount. We got a lot of corn planted in May, later May, and then it grew really fast. Had some green snap in pockets. So this, if I'm usually recommendation, if I'm going to sell it, usually try and buy all three products just because you don't know what's going to happen throughout the growing season. And so those are the three different parts. But like I said, if you have one that's really more concerning, whether it be extra harvest expense, green snap, they can be separated out.
Replant's another one, I guess neither him or I mentioned, an added replant endorsement. That's a separate one on its own. And that's been very beneficial over the last 5 years or so. I've sold a lot of that. Pays a little differently than what your replant coverage on your underlying multi-peril policy does. Pays at acre one, pays a little bit more than that underlying policy. So, highly recommend looking into a replant policy if you're not already buying one. Also covers Jason's slide of top 10 things not to do that he didn't get to, but I did peek at it, and on the list there was planting soybeans late. So early planting soybean has been a fad here lately, and it's worked in a lot of cases. So that extra replant endorsement also helps you out if you want to plant some soybeans earlier.
Yeah, because most of those policies come with an early rider. The federal crop replant date for corn and beans is April 5th. A lot of these policies will grant you, 10 to 20 days earlier than that. So if conditions are right and you want to go plant beans in March, end of March, you are at least covered for that early replant. So, and the other thing that's popular too, the hail, the wind, the replant, if you purchase all three together, most companies have a discounted bundle for purchasing those in tandem. I'll breeze through this slide. This is just if you farm in these highlighted green counties, the high risk area have changed for 25. So get with your agent and see if you have high risk areas. Maybe they got taken out, et cetera. But that's basically what this slide is highlighting for those green counties.
We also offer livestock insurance, LRP. We have a dedicated individual that works out of our Effingham branch that is in charge of this. There's a few small changes for the year as far as the coverage levels. But if you are a livestock grower and want to learn more about this, reach out to your crop insurance agent or your local farm credit office, and we'll get you in touch with our specialist, John Stroll, out of the Effingham branch.
Okay, so as we talked about, we just had a Farm Bill extension, and obviously, I'm sure as you're all aware, the disaster aid that has been reported. So what we know of as of now is the $10 billion in economic assistance and the payments per acre on corn, soybeans, wheat, and sorghum. So that was passed on December 21st. Those payments by law are supposed to be out within 90 days of that date, so I would assume you'll be seeing those. But as far as the balance of that, the $20 billion they talked about in disaster aid, we don't know kind of how that's going to be allocated, in what form. I know a lot of that they say is going to be focused on drought-stricken areas, hurricane-affected areas down south, and wildfire-affected areas as well. So may not be as big in this area, but I can't speak to for sure. So we are still to be determined on that other tranche of economic assistance. And again, the Farm Bill's been extended for.
We've got a pretty good disclaimer down there in the red, because I've seen the payment table there. I've seen a lot of different numbers. They don't vary a lot, but and that's based off of your 24 planted acres. So whatever you reported to the FSA office in 24. You'll be receiving a payment. As of right now, we believe there will not be a sign up for this, that it's going to be a true direct payment. The other part about it, the other $20 billion that we don't know a lot about, that might be more of a sign up process. And as we learn more about it, we'll relay that message to you guys throughout the year. So I mentioned here at Farm Credit, it's not just looking into the next 6 weeks. I mean, we spend a lot of time learning new products and looking ahead to the future. And this is just one thing that RMA has already came out and said that they expect to change the multi-peril replant coverage for the 26 crop year. We have no idea what that's going to be. Hopefully, it's beneficial. But we just want to let you know that is a change that is already on the horizon, and we'll do our best to get that information to you as well when we get that.
I just want to recognize, so this is obviously everyone involved in our crop insurance department. A lot of years of experience on this slide. And again, dedicated only strictly to crop insurance, so that is all we do here. And I would like if we have other agents in this room and support staff of would like everyone to stand who is here that's involved with the Farm Credit crop insurance team and be recognized.
One thing I want to add to this is I think Tom Have told me the other day that it was like 237 years of combined experience. Jack Young in the back of the room, I just realized this last night, that all of a sudden him and I are the old guys. We've been doing this for 20 some years. But know that if you have an agent that hasn't been doing it as long, that we are a network, we're a team, we're almost a family. And, we all, throughout the growing season, throughout the year, we all get together at meetings, we talk back and forth. So just because your agent's maybe only been here a year or two or 5 or 7, have the confidence in them and that they have a team behind them.
And yeah, to wrap up, again, I want to thank all our partners and insurance providers here today. They're all represented here in this room. Great American Insurance Group, Rain and Hail, Agrisampo, and RCS, and we thank you for your partnership.
I'll add a little bit to my first statement about calling my kids. It's my daughter's 16th birthday today, so she's really going to be impressed when I call her and tell her that she's got to learn how to lay that drip tape.
So with that, I guess wraps up our portion. And
Before
if
you
have
take off, is there any questions out there you guys might have on top of your mind? Yes, go ahead.
How's the premium this year for the same product that you bought last year?
So the question was
Oh.
how the premium was compared to last year, this year.
If I had the same coverage this year that I took last year, is my premium lower, higher, or same?
Your underlying premium will be roughly the same as it was last year. If you bought ECO last year, that's going to be drastically lower than what it was last year. But as far as the rating system, and we're going to be keeping track of our guarantee price coming up here in February. December contract for corn, November contract for soybeans. Volatility factor throws a big one in there. But as of right now, the quotes that we're running, premiums very similar to what they were last year. And our corn price actually is right now is really close to where we were last year. We were $4.66 last year, and December contract
this-
today is right around that.
I think this morning with December corn was trading around 458, 459. So we're not far off to last year. So it should be very similar on your underlying RP, 85, 80% coverages. It's the big change is the ECO is what we want to get across.
Any other quick questions?
On the subsidy, that's USDA or Congress really, related with the extension of the Farm Bill.
In my opinion, and I think Jason said you're not supposed to have opinions, it's supposed to be facts. They want us all to start leaning a little bit more towards the county products. And we're going to be redoing a farm bill here coming up this year, hopefully. They could lower our subsidy levels on our underlying coverages and, raise the ECOs again, trying to kind of force you, not necessarily force you, but entice you to take those county-based, products versus individual. But that's just my opinion.
Yeah, there's still that red disclaimer on that we're not liable for anything we say.